Morning, everybody. Welcome in to Wolf Financial Live. I'm your host, Gav Blacksburg, and joining me today are Shelby McFadden and Bill Mann from the Motley Full Asset Management team for a deep dive discussion into this incredible market we're looking at right now. Going to be covering some of the implications from AI, going to be covering the job market and things that are happening there, and then talking about some of this rotation that we're seeing, as well as some of the consolidation to certain names. Let's start out with just some quick introductions before we get into it. Shelby, do you mind giving us a brief intro?
Yeah, absolutely. Hey, my name's Shelby. I have been on the MFM team almost 5 years, coming up now in March. I started on the analyst role, just really covering general equities. Recently been promoted to portfolio manager and investment analyst on our Global Opportunities Fund. So again, I cover a little bit of everything, a little bit of a generalist, but I definitely have a bigger focus in all things retail and consumer exposed. So because of the splash zone of AI, that puts me in that as well. But yeah, it's been a pleasure working on this team. Great to grow and happy to be here today.
Thank you, Shelby. Appreciate it. Bill?
I'm Bill Mann. I'm the Chief Investment Strategist for Motley Fool Asset Management. I've been at the Motley Fool family of companies since 1999. I was one of the first employees, so I've done almost everything at different parts of the Motley Fool. I was the first chief and founding chief investment officer for Motley Fool Asset Management, which we founded in 2008. It's a pretty exciting time to stand up a asset management company. We could talk about that, but I'm just excited to be here with you, Clive.
Fantastic. Excited to have both of you on. Prior to getting into this, going to throw out a quick disclosure here because we are going to be talking about some specific tickers as well as this high-level market discussion. So for the investors that are watching, please carefully consider each fund's investment objectives, risk, charges, and expenses prior to investing. The fund's prospectus and summary prospectus can be found right on the website, and that website is fulletfs.com. For those that want to check it out right on there, all the information can be found. So again, to obtain a fund's prospectus and summary prospectus, visit the website at fulletfs.com, and those should be read carefully prior to investing. Excited to be working together with y'all, and a big shout out and thank you to CBOE for helping to sponsor and set up this live stream today. So with that being said, we're going to get into these, and the tickers specifically that we'll be talking about are TMFC, which is the Motley Fool 100 ETF, which gets exclusive access to the top 100 largest and most liquid U.S. companies that are recommended by the Motley Fool, as well as TMFE, which is the Capital Efficiency 100 Index ETF. We'll talk more about these as we get into some of the finer details, but want to start out high level here with yourself, Shelby, talking about this AI implication on the market, because that seems to be the driving force that's creating the shifts that we're seeing today. So I'll turn the floor over to you.
Yeah, absolutely. And I'll try not to monopolize the time here because it's it's everyone's favorite topic, so I'm not unique in this, right? But I think probably 2 years ago, maybe even a little bit more, closer to when I started here, there was a question of, are companies like Meta wasting their time? Like, let's think about this. Less than 5 years ago, we were saying, is this CapEx reasonable? Are people going to buy these goggles? Like, what is the point of this? Is this the only thing that we were thinking you could spend this money on was so narrow, right? And I shouldn't say all of us, some folks had it figured out, but a lot of the retail market was just thinking, what's the point of this, right? 5 years later, we've got competing Super Bowl ads. We've got Copilot that's absolutely putting up a force of nature against the likes of Salesforce. We've got companies pretty much just doing circular investment because they're realizing the sort of environment they're in now. And so then it went from what could this even be to, well, this is everything. So stage one was this changes the future, this broad sort of black box of disruption. And I don't know what it's going to do, but it's going to do something. So then it starts to be, all right, well, we can sort of base it off of the backlog. We can base it off of NVIDIA sales. As long as there's someone to sell to, everything will be fine. Then the second stage was, well, everybody can't win. And we started to see that in January, where you see, okay, well, maybe software is going to be in a little bit of trouble here. And then it's, well, what about actually outside of the market? What about outside of enterprise companies? What about the actual economy? So we assumed that TFP, total factor productivity, was going to just rapidly expand. And it most likely will. I think we'd probably be hard pressed to find a number of PhDs who would disagree with that. But that's the long-term implication, right? And so now we're in well, what's going to happen to jobs? Because we've had the sort of white collar recessions before. And part of it had to do with, well, we've replaced your job a little bit. and we don't need it, or, well, we spent a little bit too much buying all those chips and we have shareholders. And now we're at a point where, well, what about the blue collar jobs or the gray collar jobs, if you will? What about those middle parts? And that seems to be, I don't know how many stages we're going to have, but it seems like we're in stage 3. Bill, yeah, go ahead.
It's so funny because there are periods of time in which we just, we're just like, yay, capitalism, like things are ticking along as they are. And then we come to periods of time, and I suggest that this is one of them. The metaverse may have been a failed one before, but the rise of the .coms was definitely a third, where you go back to the philosophical underpinnings of what capitalism is and what economies are. And there is this interesting tension right now that says, okay, AI is going to come in and steal all your jobs, and it's also going to add to 1.5% annually to GDP.
Yeah.
Those two things cannot happen together. Right. So you go back to, we can have our, we can have our undergraduate, we've got a pot of bourbon on, we're talking about Joseph Schumpeter and creative destruction, and, it's going to destroy a bunch of jobs. We've seen that before, saw that with the .com, but new jobs are coming.
Right.
I tend to think, Yeah,
no, please finish the thought.
I tend to think that it's the Schumpeter argument in this case is a little tough. Right. It's a little tough because for the first time, you're really looking at a like for like, where knowledge economy jobs are under threat. Yeah. I mean, that's what's under threat. You remember the jokes about learn to code. Well, I don't know if learn to code gets you there anymore.
I lasted for 7 years. I'm not even sure. But learn to code I was in my undergrad before I took on economics. I was studying international affairs, and they're like, you're never going to get a job. Well, the learn to code kids, it didn't work out that well.
It's so funny because I was an international affairs major also. So I studied Marx, I studied Schumpeter, I studied Hayek, and I think Hayek is actually the best example here.
Right.
God, we were getting philosophical super fast. Anybody on the West Coast who it's like 8:30 in the morning for, I apologize. But Hayek basically said that the brakes on this is actually comes from the fact that if jobs don't come, these investments are going to be wasted.
Right.
There's your break for AI. And I'm not saying that's necessarily good, but there's your limiting factor.
Well, and it's interesting too, because I vividly remember probably maybe 10 months ago or so, there was a lot of chatter about how the EU was saying we need to regulate this immediately. And the United States,
by this you mean everything, but go ahead.
AI, right? But everything, but specifically AI. And this is just totally objective. This is not a comment or anything. But the United States was like, no, let it run. Right. Let's see what it can do. Mm-hmm. And I have to tell you, I didn't think that we would run into any hiccups this fast. I definitely thought it would take like a few more years before people started to think about, well, hold on a second. What are we going to do about jobs? Now, to Bill, like Bill said, and what the numbers are showing us is that it's not dire yet. I mean, developed country, 4-ish% unemployment. It feels uncomfortable because we're used to it being extremely low, but it's not that far off. But it is interesting to so much faster than we expected be in a time where we're like, we don't need to regulate it, but we should probably think about it. Like we should think more seriously about it than just let it run. So it's interesting to be there so early.
Gav, I feel like you said good morning and then we just went off. So
no, it's fascinating. You just have me wondering, like, who is safe?
Do we have jobs tomorrow? Who knows?
So
tell me, I've got some bad news. No.
I'm just curious, with this knowledge in mind, how it translates into the investing side, because people are hearing like, okay, shifts in employment, AI coming in, maybe specifically to start out with TMFC. So these are going to be, companies that are being recommended by the analysts. And I think that this is an area where you can kind of take the brain power and put it together. So I'm curious, are you seeing the makeup of this ETF really adjust with the times of what you're talking about?
Thank you for bringing up TMFC. So clearly, give a little bit of the philosophy of the Motley Fool because it informs everything that we do. The Motley Fool analysts, who are the ones who are making the recommendations that go into TMFC, are really looking for the highest quality companies wherever they are. And so, obviously, they've got plenty of exposure to the Mag 7, have identified some of those as early as like 1998. We also do have plenty of exposure in other parts of the market where we are looking for the highest quality companies with the best balance sheet, the best growth prospects, things of that nature. Because it is a passive fund, it tends to lag. I mean, that's just true of every passive fund, that at the point in time in which they are reconstituted, and TMFC is quarterly, that's when you're going to find out what the market's been telling you to some degree. But if you look at what has been working so far in 2026, it's
Right.
not so much the Mag 7. And I think that, obviously across the board, those are the highest of high quality companies. But I feel like there's a bit, I guess maybe the fanciest way to put it is valuation fatigue. It's worked for so long. But then you start to look at areas like energy, for example, which obviously has a much bigger, quicker role to play in the build out of our AI overlords. You've got materials, you've got consumer staples. So we have plenty of exposure in those areas. You tend to see that happen, on a little bit of a lag, just given the passive construction of this fund. But that's true of every passively constructed fund.
Mm-hmm.
Shelby, you have thoughts on it as well?
Yeah, I would agree that I forget what conversation I was having, but it's kind of like if you own really any part of this market, to Bill's point, you're owning these big players, right? You have to work really, really hard to avoid it and still be diversified and succeed. Right. So there's a number of different elements there. And what we do have in TMFC is an unsurprising representation of the Magnificent Seven toward the top of the portfolio, because to Bill's point, they have been the best performers. But what you also have are names that are a little bit less thought about, names like Visa and MasterCard, names like Walmart. There's a little bit more chatter about them now because people are recognizing them as compounders, and compounding is becoming a lot more valuable. Why? Again, to Bill's point, people are tired of paying. And it's not just the folks who are looking for a bargain. It's, when do I ever get an opportunity to participate? And if you can't participate in these sort of headliners, then you have to look for other companies that are doing still very well for how long they've been in the game, and for the size market share that they do have. So I find TMFC to be, yes, it can be you're going to get a good amount of exposure to the top names in the market, but you're also going to be able to benefit from any little sort of return to breadth that you're seeing in the economy based off of really high quality choices that the analysts have made and are regularly taking a look at. So it is still a more diversified product. And in some ways it's I always like to say it's active without breaking a sweat, right? Like someone has made an active choice for you, apart from just what you can get from getting the S&P. So you're getting the best of both worlds of having some bottom-up research and saying, you might not have heard of this, but this is actually a phenomenal company. I could talk to you about it for 45 minutes, but also we're going to get you some of that cream top off of the market because we're aware that these are also some of the best companies too.
Yeah, absolutely. And it has outperformed over the last 5 years. If you look at it, it's outperforming QQQ, it's outperforming SPY. Some of the names, like you did mention, right, people are going to be very familiar. Mag 7 makes up 8 of the top, names, with AVGO inside there as well. And then Visa, Walmart, and so on and so forth. And a lot of people have been attracted to this, obviously, a couple billion almost in AUM as well on that side. How does this differ, just as people think about it, TMFC to TMFE?
So TMFE is, if you overlay them, they have a pretty similar set of companies, but TMFC is simply market cap weighted. So it's the largest 100 companies that are recommended by Motley Fool analysts at our sister company. TMFE has a limit on market cap size, on the position size within the fund. So it's at reconstitution of 4.8% limitation. So you're not going to have as much exposure to the biggest names on a percentage basis, but it also has a capital efficiency overlay. So we're looking at things at companies with high returns on capital and ironclad balance sheets and growth that comes in a very efficient way. So there is an overlay there that tends to, and I say tends to because it's there's no guarantee, lower the volatility a little bit because you're just not as exposed to single names as you are with TMFC.
Mm-hmm.
Got it. Zooming a little bit out, separate discussion from what we were having before, although we can double back to AI if we want. One of the big things I think is a topic for this year that I'd love to hear your thoughts on, maybe Shelby, if you want to go first, is the new Fed chairman that is expected to come in, and just overall how you think this administration and Fed chairman affect the market moving forward.
Oh, so many thoughts. Here we go. Let's be fair.
I'll be back. No.
I remember where I was when that tweet came out, and I was in a room with a lot of financial media people, and it was chaos. I mean, it was not negative, not overly positive, but it was just kind of like, it's done, right? Like, we can all take a breath, but also, what is this going to mean? And the sort of market reaction seemed immediately a little bit more to the hawkish side. And then as people started to really sit and think, like, who is this Kevin Warsh guy, right? Like, let's actually take a look at what it is that he's been saying, and not just say, well, I mean, I have this one soundbite, or Trump picked him, and so this must mean X, Y, and Z. What we started to see is that this is not necessarily going to be a story of him stepping into the building and going on an absolute quantitative tightening rampage. It's very unlikely. The things that we have to consider here are, one, the Fed system that we've been operating in has been running on ample reserves. That's the sort of system that they've been sitting on for a really long time. In order for Warsh to start any sort of balance sheet winding down, which is his preferred mechanism for getting to a lower interest rate environment, you can't run into quantitative tightening in this same sort of reserve system. So you would need to sort of work with Treasury and somehow maintaining independence, get to a world where we have a bit less regulation so that banks are encouraged to buy government paper. You change sort of what their reserve system looks like, and you change how much the Fed then has to be involved. That's sort of what we imagine Warsh doing. We don't imagine him doing it in June. I think it's going to take some time. They have to take an assessment. I would also say that my analysis on Warsh is that he's going to be a little bit more focused on market signals and corporate data. He's much more of a supply and demand sort of guy, as opposed to just looking at PCE, looking at CPI. So still going to be a data-driven Fed, but the data that they use might be a little bit different. But I think the TLDR is that, one, he's not coming in with any sort of wrecking ball. Yes, he might be a little bit more friendly to this administration, but Jay Powell was chosen by the former Trump administration, and he's not exactly let the economy run loose kind of guy. So I think things will be different. I think they have some differing philosophies, but here's the other thing. The Fed chair is not a dictator of the Fed. He has counterparts to answer to. And I don't think that there's a record of him being someone who's difficult to work with. He has a different philosophy, but I tend not to think we're going into this new era of just a sort of like Fed dictator that's going to completely change our financial system. I think he has an outlook where he wants to bring more money to Main Street, but I think it'll take a couple years for that to execute.
It doesn't seem like he has like that overarching personality that that like a Greenspan had, or even a Bernanke had. Like it seems like, I think a lot of the stress around Warsh has been fear that he's going to be a company guy. That Trump obviously been much more political, overtly political about pressure on the Federal Reserve and the Federal Reserve chair than has been the case in the past. But let's not let's not deceive ourselves. Every president has really hard conversations with every federal chairman. It just Trump does it,
Publicly.
on social media, as opposed to in the annals of of the White House, in the Oval Office. It happens every time. But we've seen this time and time again, that people, once they get into those chairs, they act in ways that are
Right.
not necessarily predictable based
Mhm.
on who brought them into that spot.
Very interesting. How do you think that he will look at this rise of AI and unemployment?
I
It's a
tend
crisis-unity. Is that a word?
I like that, Bill. I tend to think he'll be excited about it because to come back to really what we're all doing this for, capitalism. I do tend to think he is more of a market oriented guy, and so we are kind of seeing the beginnings of the impact happen on Pal's way out.
Mhm.
I don't think he hasn't been thinking about it, but it hasn't been the top of his list, and employment hasn't cratered in such a way that he's had to say what's causing this. I wouldn't necessarily expect the Fed to be coming out and saying things like, the Treasury ought to make investments in this, or I don't think we're going into that sort of era. But I would imagine that he might actually be a little bit less concerned, because I tend to think he's the kind of guy to say, let the market forces do what they're going to do. Wait a few years and see what happens. If this blows up in our face, then I have a job to do. But if not, then the market did its own job and the economy thrives.
We think a little bit about the K-shaped, the K-shaped economy, and what has happened in the lower leg of the K, and let's call that the
Yep.
bottom 40% of earners in this country, is that AI has already impacted them.
Yep.
The ones that are going to be impacted, it has already happened. The others in that part of the market are, plumbers aren't going to, there's not going to be an AI plumber. There's not going to be an AI electrician. There's not going to be,
You don't think so? The
there are,
robots? Optimus?
I forgot about robots.
Bill.
I take it all back. No, but
It'll be a while.
it'll be a while. Exactly. Our robot overlords are not showing up tomorrow. So there are elements of the parts of the economy that have struggled, that are that they're held pretty much harmless from AI at this point. It's that 40 to 80 or 90%, of the earners in the market, in the economy, that do have to be concerned. And I think that's that's a part of the market, and that's a part of the economy that's done pretty well.
Mhm.
And I think that's been one of the huge challenges for the Fed up until now, is that on the top line, unemployment seems like it's okay, but there have been pockets of absolute chaos within the economy, who could really use some loosening of the purse strings.
Yeah, that makes sense to me. We've got we're going to run for another several minutes here. One other topic I wanted to make sure we touched on is where ETFs like this fit into a retail investor's portfolio. And I think that the most likely thing that they're substituting in for it is going to be S&P 500 or broad index exposure. And we had a little interesting conversation, Bill, that I wanted you to talk more about, which is the S&P 500 does the opposite of what most portfolio managers do, right? The bigger a company gets, the more they add of it. Yet it outperforms. And maybe you could talk to a little bit about that, in terms of how you think about this ETF and where it fits in and how people should think of it versus an S&P 500.
Yeah, it's really funny. If you think about what portfolio managers are supposed to be doing, I mean, every time you have a conversation like, what's the moves? How are you reacting to this? The S&P 500 doesn't do any of that, right? If a company gets larger, even if you could look at it and say, oh, that's tremendously overvalued, there's no guy named Stan Poors who's making a choice and dialing back. They're just simply going to match whatever the market is going to tell them to do. And the really interesting thing to me is that it's worked. And it's worked because there's a great piece of research done by a guy named Meb Faber from Cambria Asset Management, and he just described the power law of the market, which just shows that very few percent of the companies that are in the market account for almost all of the gains.
Right.
Almost all of them. So they tend to be high quality companies. So that to us makes perfect sense for where you might want to remain. You want to remain in high quality companies, even if, as has happened in 2026 so far, quality is not the thing that's performing all that well. I mean, if you tell me, hey, high quality companies aren't going to do that well for the next 8 months, I'm probably not going to change my mind in terms of holding high quality companies. It is where the gains have been. So when you think about the full the Motley Fool asset management universe of ETFs, what you have to know is that at the very top line, we have we have a set of companies, a universe of companies that are in our analysts' discretion, consider to be amongst the highest quality companies that exist.
Right.
It is diverse, but it's not fully diversified. Like, we're not going into segments in which there are lower quality companies. Like, we just simply aren't going to go and try and find the highest quality newspaper company. It's just not going to happen, right? It's not how we think. So when you're thinking about whether to, allocate some of your funds to a Motley Fool asset management ETF like TMFC, the thing that you have to know is that we are going to be very comfortable with being wrong on the whole quality thing for periods of time. You've got to be comfortable with the fact that we are not going to overreact to the market telling us over periods of time that we're wrong, because going back and Meb's research went back decades. We know what works. And so that's what we focus on. And, if that is of interest to you, then then we've got a home for you.
Very interesting. And Shelby, can you just elaborate a little bit further on that concept of what is quality, what's not quality, what a rotation away could look like from it, and how not to get, faked out by that?
Yeah, absolutely. I think the first thing I start with is it's not finance if we don't use sports analogies, right? So in our house, we're big football people. And the one thing we always say after our team gets a penalty that, of course, we don't believe that they deserved, and then the other team has a failure, is ball don't lie, right? And so similarly, in this line of work, we say cash is king. And you might be sitting there saying, how's this guy really going to tell me that, their lead factor is going to suffer for 8 months and he's fine with it? It's because one of the main things we're looking at is cash flow, not net income, not earnings per share, free cash flow to equity holders. What is it? Are they positive? Is it stable? If we're looking at a portfolio where we're looking at total shareholder return or dividends, are we concerned about it? That's really what matters. It's always going to be that tangible asset. In some of our smaller companies, even though they may not be holding up super well against the large cap, because we know smalls have been getting crushed, we've got a number of small companies that are still growing in mid double digits, and they are debt free. Right now, of course, we know that debt is a tool. So we're not sitting here saying, choose companies with no debt, but that is remarkable. So they're producing cash based off of just the cash that they earned last quarter, right? So when we then want to break into how do we get to those sorts of companies, our team uses a 4-pillar system. First is management culture and incentives. These things do matter. This is not just the sort of like ESG components. This is truly like, do we trust these operators? This is where we're looking at the sort of like, is this a BS restructuring program, or is this actually a necessary cost-cutting regime that they're going into? Is this someone who is being paid to essentially just break things and has a golden parachute on their way out? Or is there a really deep bench here? What do we think of the board? Are people actually trying to work for the success of this company? What is their turnover? At bigger companies, it's a little bit tricky. If you're looking at a logistics company, turnover is diluted by things like holidays. But when you're looking at a small to medium-sized company with high skilled labor, you don't really want to see people leaving all the time. So those are the sorts of things we look at. The next thing is economics, right? This is, if you did the CFA exam, this is all 3 levels of all your pain shoved into one Excel sheet, right? So that's just the grueling part of financial statement analysis. Then we're looking at competitive advantage. Where do they rank amongst their peers? Because In 2026, there's not that many companies that are doing something that someone else isn't doing. So what's the reason that we should either choose them now or overweight them versus another, or should we do a barbell? And then the last thing is trajectory. Just where are they going, right? Is this a company that's probably going to be around forever? Is this a company that we think might get acquired, but we believe that it's super high quality and we are happy to be on board for the 8-year journey to them growing from 5 billion to 20 billion and getting acquired? So when we take all of those things into account, we realize that the market doesn't oftentimes reward management teams. Sometimes they reward outspoken CEOs, and sometimes those CEOs actually show up and do what they said they would do. I'm looking at you, Bob Iger. Crazy work for Disney that man did. But a lot of the times they just don't really think about it. So while the management team isn't necessarily getting penalized, they're not really getting rewarded either. And cash tends not to be king for this market. Sometimes there's an overlap, but a lot of times it's just, what are sales growing at? Sometimes the market's not even really looking at profitability. So when we think about what's always going to be around, it is, one, are they making real tangible money that in theory could be given back to us? And two, do we have confidence in who's at the helm? And I think when you look at companies like the Walmarts and the Costcos of the world, a lot of the reason that they're being treated like such high growers is because of the quality of their operators. A great litmus test. It is just to watch what happens to a stock when the company announces their succession plan. You can learn a lot just from that behavior.
I like how Shelby broke it down because she's
Masterful.
she's describing the spinach part of our research, which is the economics, which is, is literally, that's exactly the right description. It's all 3 years of the CFA, the middle part. But then you're also talking about the lying down in a field and staring at clouds. Like, what is this business going to be like if you jump into the DeLorean with Doc Brown, go 10 years into the future? What do you got? What's Walmart doing 10 years from now? What's Microsoft doing 10 years from now, et cetera? And it's
same thing for Walmart is my guess.
Yeah, exactly. Exactly. And Walmart's such an interesting, it's such an interesting case because it generated basically zero returns from 2000 to 2010 from a stock perspective. But you look at the business and it was going gangbusters. And it took that long for the market really to notice. So, our game is we're going to keep holding Walmart until Walmart tells us that it's not, it's no longer a high quality company.
Right. Microsoft in a similar circle. Right?
Exactly. Yeah, exactly. Amazon was too. Amazon, took 15 years to hit below its all-time high and was down 91% at one point. I mean, these are old stories, but it's the foolish philosophy to have remained focused on what these companies were doing during that length of time.
I love the approach. I think it's really, really great. Just giving a quick share here on the screen for the audience that's watching. For those that are curious, you've been hearing all these amazing insights and thoughts from Bill and Shelby on here, and you're wondering, how do these things get actually put into play? Here's where you would go check them out. So go to the fulletfs.com website. You can see the ones that we've been talking about here, TMFC as well as TMFE. You can click in and see much more detail on them. Also, of course, you can see in Shelby's name, she's got TMFG listed as the portfolio manager. There's a bunch of others on here too that people can look through in terms of if you're looking at some of the newer funds that are coming in, innovation, growth, value. There's a lot to check out on here. I've really enjoyed the time that you've both spent with me. Wanted to check, Bill, first, any final thoughts on this conversation?
No, I think one of the really important things for people to focus on is not getting too wrapped up in in what the market is telling you at any given moment. I mean, we already saw this week. There was a news story, an analysis that came out. It basically said that that software was dead. And look, it may be that software has a changed reality, but things do change much slower than the news cycle tends to allow. So give yourself the grace to be wrong a little bit and try not to be wrong a lot.
Well said. Shelby?
Yeah, I think my closing words are buckle up. Active managers are working a lot harder in this season because there are so many opportunities. So we are not chasing anything, but we're definitely at a sweaty jog. So stay alert and frankly enjoy the sea of opportunity that this market's giving us.
Well said. I feel coming out of this, I have a nice deep education as well here on the value side. I love it. I encourage people to really think into those different methodologies that Shelby and Bill outlined as to how you should go into this market. Do not panic, right? In this market, have that long-term approach. I think that that is typically the type of person that outperforms. I want to give a special thank you to our friends Amy and Mark over at SIBO for helping to set this up. And a big shout out to the whole Motley Fool Asset Management team. That's going to do it for this stream. Thank you to everyone on Wolf Financial Live that tuned in. Also, we had about 3,500 people watch this. So appreciate all that came. We'll have more content later today. And of course, we'll be dissecting NVIDIA earnings later today. So much more to come.